only show hosted. Welcome to On the Money right here on WDBO. My name is Greg Rhodes, joined today by the people of Certified Financial Group, the people who are planning your financial future, making your tomorrow just a little bit better than your today. Joining us today, we have Nancy Hecht and Joe Bert, Certified Financial Planners with the Certified Financial Group. And you know by now that for more than 30 years, the professionals at Certified Financial Group have been answering your questions for you every week right here on WDBO's On the Money. They've become Central Florida's most listened-to call-in program, and it's the only call-in program where all the hosts are certified financial planners. And again, our hosts today, Nancy Hecht and Joe Bert.
Good morning, Greg. Thank you for the kind introduction. And yes, we are a call-in program, and you said it's the only call-in show that's hosted by certified financial planners. If you listen closely to the radio on the weekend, there are a lot of financial shows, but none of them are call-in shows. They're all recorded shows and our 1-hour infomercials. But Nancy and I are here this morning to take questions that might be on our listeners' minds, things you might be deciding what to do about your IRA, about a 401k, about long-term health care, reverse mortgages, stocks, bonds, real estate, all the things that Nancy and I, the 15 other certified financial planners, do for our clients Monday through Friday, providing retirement planning, investment management for a fee. But on Saturday morning, we are here for you absolutely free. So if there's anything on your mind, things you've been thinking about, things your brother-in-law may have told you that doesn't sound quite right, things you want to talk about, things you've heard in the news, we are here this morning. And the good news for you is that the lines are absolutely wide open. You can be first in line by picking up the phone and dialing these magic numbers.
That's right. And those numbers are 844-580-9326. It's 844-580-WDBO, or you can also use that open mic feature inside the WDBO app. And don't forget, we do have Dave Balakrishnan this morning taking calls off the air. If it's a little bit more of a private conversation, that number is 407-869-9800. And today on air, we're going to be focusing on the topic of revenge saving.
Yeah. Revenge savings.
Not a phrase I've ever heard of.
Well, it's something that many of us never heard of. I was scrolling around and saw this topic, and I thought, this is really interesting.
Sounds like getting even.
Well, it's getting even on your own behalf.
Oh, there you go.
So it's the equivalent, they're stating, of a financial wake-up call. Taking control of your finances. We've gone through a long period of time where there was a lot of overspending, emotional spending, online shopping, people trying to justify doing whatever to try and make themselves feel better.
Kind of coming out of COVID.
Right, basically, yes. And now is the time that people are trying to work on things to try and make themselves feel better financially and do it in a fast and furious way. It's not really about stockpiling cash, but it's about trying to reclaim some financial clarity and some financial calm. Let me give you some of the points that are stated about revenge savings. One of the things you have to do, and this is something that we talk about frequently, is identifying what your financial goals are and making sure that you stay focused. Are you concerned about your retirement? Are you concerned about building an emergency fund? Do you have some big life cycle event coming up?
Such as?
Well, maybe you have a kid getting married, you have somebody graduating, somebody going to college. I have a milestone anniversary coming up next year. So these are the types of things that people hopefully will save for and be able to pay cash for these large events. Another thing to look at, and this is something that we've talked about in the past too, is hidden spending.
What's that?
Well, one of the things, for example, is, you sign up for all kinds of subscriptions.
Oh, yes.
Or, we've talked about streaming services. So there's been a lot of consolidation in that arena. So you may be paying for, 3 or 4 different things, and only really getting services from one of them. So it's important, and I have mentioned in the past, make sure that you look at your bank statements and your credit card statements to make sure, first of all of the charges or debits are ones that are yours. And second of all, you can find these items popping up that you have on like a recurring payment, but you're not necessarily using them anymore.
Those do add up.
Yeah, they do.
It's amazing how
a
they add
lot.
up. Yep.
So, I mean, I had mentioned this yesterday when we had some company over, what I was going to be talking about, and one of the streaming services that we're paying for, my husband said, I think now that's encompassed in, ABC instead of being separate, and I need to look at it. So, I mean, it may not be much. It may be, $5 or $10 a month, but over 1 year and over many years, it adds up. So if you look at maybe taking 30 days to focus on what you really want to attack as far as savings goes, and write things down, and start focusing on specifically the things that you want to do. And then looking at things like, what can you cut out? I had just mentioned streaming and stuff like that, that maybe you can accomplish the goal, sort of, for example, like eating.
We're going to eat. So
Okay, so
what are you suggesting?
a lot of my neighbors have food service deliveries
Oh, yeah.
many, many days a week.
Oh,
And I cook every night, and I know that
you mean those pre-cooked meals or those pre-packaged meals where you just...
or you're doing Uber Eats or
Oh,
something
gotcha.
like that.
Yeah.
So,
Oh,
first of all, I don't think it's as healthy as cooking for yourself. And second of all, it's a lot more expensive. So looking at something like that and how much money are you actually spending getting food delivered versus if you were to cook it yourself. And it may not be much, but those little dollars add up over a long period of time. So the one thing that's really important too is to make sure that you have your goals for saving being manageable, so you can stay the course and not feel like you're being deprived.
so how would that work?
Well, so you have to put together some type of strategy.
There you
So,
go.
for example, if you're looking at your retirement accounts and you realize that you've been participating in your company 401k for 5 years and you've never done anything more than the automatic 4% match that is credited, in activating your account once you sign up.
So you never adjusted, never made any increases? just-
Right.
It's on autopilot.
And I think that, saving to the match is
It's a start.
it's a start, but it's not sufficient.
Right.
So look at, have you thought about what age you want to retire and what kind of dollars might you need to be able to accumulate? And if you go from 4% contribution to maybe 6%, it's really not going to be any more money out of your pocket, because right now you're paying that money to the federal government in the form of income taxes, and now you could be putting it into your own account if you're doing traditional 401k versus Roth 401k.
Yeah, that's the important thing. You just said there's no more money out of your pocket. I can see some listeners saying, well, there's no more money out of my pocket. I don't have it. But yes, you do. You're just taking it out of your paycheck and putting it into your savings pocket, your savings bucket.
Right.
And that's the important thing. And as you said, it's tax deductible and it accumulates for without being taxed. That's as we've seen time and time again with our clients, Nancy, saving your retirement is the biggest challenge that people have.
Right.
And using your retirement plan to the max is where you want to start.
And it's about control. It's not necessarily about sacrifice, but it's about taking control. So, and I think that the retirement savings portion is one area that people could start and really take control. I've had people come in and to do retirement planning, and they bring their pay stubs, and they look at the part that's going to federal income taxes and, they basically want to throw up. Well, you have the opportunity to put that, again, as I just said, in your own pocket, as opposed to being philanthropic to the federal government.
Right.
And it'll make a huge difference.
Yeah, because as we've said time and time again, when you retire, you're only going to have Social Security plus whatever you've been able to save for the most part. Most people today, unfortunately, don't have pensions anymore. So retirement is really what your Social Security is going to give you, which is below the poverty level, and what you've been able to save. And your retirement plan, by far and away, is the most cost-efficient, tax-wise, best way to save for your retirement. But most people don't use it to the max.
Well, and on the lines of Social Security, they just stated that the cost of living increase this year is going to be 2.7%, which is actually in a normal range. But seeing as we had been in a period of time where things were quite inflationary, the cost of living increases had been more significant. And then on the flip side, if you delay Social Security, you're going to get an 8% bump for every year you delay beyond full retirement age to age 70.
Plus the 2.7.
Right.
Yeah.
And I have no idea where you can get a guaranteed 8% increase in your pay other than the federal government.
Right. That's why time and time again, if possible, and it doesn't work for everybody depending on your health and family situation, but you want to defer taking that Social Security for as long as you can, because that 8% increase that you get into payout plus the cost of living, as you said, really adds up over time.
So, I mean, just to wrap up the whole revenge saving thing, you have to look at, what are your short-term, medium-term, and long-term goals. And you have to be aggressive about your saving, whether it's into checking, savings, money market, or your various different type of retirement accounts. And don't ignore the emotional component of money. I mean, you don't want to get hamstrung by the emotional component of money. But you want to realize that it really does have an emotional impact on everybody, and acknowledge that, but don't let it paralyze you.
Yeah. I just read an interesting study that over 90% of people, whether they want to admit it or not, make money decisions emotionally, not rationally.
Well, yeah.
And we're all emotional beings, and that's the problem. And the emotion overrides the rationality when it comes to saving and investing and making investment decisions. And we've seen it time and time again. You got to get that emotion out. And frankly, that's why people hire us as behavioral managers, to keep them from really making those kinds of mistakes. As I've said, we're as much behavioral managers as we are money managers, and that's what we do for our clients.
So anyway, just to tie into that, some people that I met with yesterday is you have a lot of psychological and emotional analysis in with everything that you're providing for us, don't you?
Oh yeah, that's it's we are all emotional beings, and our job is to really do the best for you we can based on past history and investing and so on and so forth. But it's also to keep you from doing the wrong thing at the wrong time, and that's really how you become a long-term financial success.
Yeah.
Anyway, I see we're up against the break there. Greg, take it away.
That's right. And if you've had any experience or have more questions about this idea of revenge saving, go ahead and give us a call here, 844-580-9326. That's 844-580-WDBL. We'll also take any of your other financial questions if you do have any that you'd like to get in on the air today. You've been listening to On the Money, where we're planning tomorrow
Today
with the Certified Financial Group.
For more than 40 years, our certified financial planner professionals, acting as fiduciaries, have been providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're a certified financial group, but we're planning tomorrow, today. Our fiduciary approach of providing retirement planning and investment management for a fee seems to resonate with our clients. But don't take my word for it.
I knew a gentleman that I worked with who had come to the Certified Financial Group.
A friend of mine recommended them.
and they were totally correct how good they are.
I had heard from somebody else that it was the best one in town.
I've sent several of my teacher friends here.
We're Certified Financial Group, where we're planning tomorrow, today. You may be new to the area, but we're not. For more than 40 years, our certified financial planner professionals, acting as fiduciaries and providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today. Black Monday, the dot-com bust, 9/11, and now 2 wars. We've pretty much seen it all. Acting as fiduciaries, our CFP professionals have been a steady hand guiding our clients to and through their retirement years.
No reason to be worried about anything.
Stay the course. You stay the course, and you get there.
I don't have to worry about it like I know a lot of people look at it every day. I don't have to do that with the team here at Certified Financial Group.
We're Certified Financial Group, where we're planning tomorrow, today. Are you tired of trying to reach your advisor through a call center and being put on hold for 20 minutes? That's why we don't use one, and our clients seem to appreciate the personal touch.
They always answer my questions and really care about what's going on with me.
You can trust what they say, and they do what they say, and it gives you a comfort feeling it's hard to find in the world today.
Waiting for you to call almost. You almost feel like that.
We're Certified Financial Group, where we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
Welcome back to On the Money here on WDBO 107.3 FM and AM 580. You can also listen live on the WDBO app wherever you are today. And today we have Nancy Hecht and Joe Bert from the Certified Financial Group. If you have any questions about your finances, go ahead and give us a call here, 844-580-9326. It's 844-580-WDBO. Open phone lines for you to get your chance to ask your important financial questions. Again, 844-580-WDBO. You can also call 407-869-9800. That's where Dave Balakrishnan is taking your calls off the air today. And now back to our hosts today, Nancy and Joe.
Yeah, I see we had a text question floating in there. Greg, you want to read it?
That's right. I heard that ding. We've got the, let's see, Rachel out in Windermere has a question. She wants to know, with the current interest rate cut that just happened this last week, what happens to my bond funds?
Well, there's an inverse relationship between the price per share of a bond fund or a bond in general and interest rates. So when interest rates go up, bond prices go down. We're coming out of a period where we had an unprecedented 11 interest rate increases. In my 40 years in business, I have never seen that before. So what happened is as the rates ticked up, the price per share on the bond funds went down. So you had a higher dividend that was reinvesting and buying cheaper shares. So that's a good thing if you're in the accumulation period. So now looks like the spitting match between Trump and Powell is over and rates are finally going down. So we just saw a 0.25% drop. So that means the interest rate that's being paid on your bond funds ticks down, and the price per share or the value of the bond funds will go up. And I think it's important to remember that that is the relationship. When I've been doing some reviews and updates recently for my clients, the value of bond funds have definitely taken a hit, and they've gone down simply because of this natural relationship. And just because something has decreased in value does not mean that you have taken a loss with that particular asset. You only take a loss if you actually sell something and then you realize it. So we're going to see more interest rate cuts. Some are saying that there's going to be 2 more this year, which I don't believe. I think that there will be 2 or 3 next year. And as you see the interest rates going down and the yields being paid on bond funds normalizing, you're going to see the price per share on the funds going up.
Right.
So that's it. It's just a seesaw kind of relationship. One thing that's important, as far as I'm concerned, when looking at bond funds is something that's called duration. And that's the average number of years that a portfolio manager holds a bond in a fund, irregardless of when the bond matures. And I like durations that are under 5 years. I mean, in our world, 5 years is deemed to be long-term. And I want something that's not going to be long-term. So then that seesaw between the rates and the price per share on the bond fund is not big.
Yep. So the thing to remember, as Nancy said, is when that share price drops in your bond fund, but you're getting higher dividend or interest, you're reinvesting, you're buying more shares. And so when it flips, you have a lot more shares to provide a lot more income. So owning bond funds in many ways is a lot more advantageous for most people than owning individual bonds. People like to hold bonds because I know at maturity I'm going to get my money back. But really, if you're looking for purely income, an easy way to manage it, a variety of bond funds, whether it's corporate bonds or municipal bonds or government bonds, there's a variety out there to provide income, and it should be part of a balanced portfolio. So that's what the funds are all about. I hope that answers Rachel's questions. And I hear the music. Greg, take it away.
That's right. And if you have any more questions about those interest rate cuts, or as Nancy mentioned, the idea that there could be or won't be more cuts this year, go ahead and give us a call here. We'd love to hear about it. 844-580-9326. The number again, 844-580-WDBO. Open phone lines. You'll be first up when we come back from the break. You've been listening to On the Money, where we're planning tomorrow
Today
with the Certified Financial Group.
Hey! Black Monday, the dot-com bust, 9/11, and now 2 wars. We've pretty much seen it all. Acting as fiduciaries, our CFP professionals have been a steady hand guiding our clients to and through their retirement years.
No reason to be worried about anything.
Stay the course. You stay the course, and you get there.
I don't have to worry about it like I know a lot of people look at it every day. I don't have to do that with the team here at Certified Financial Group.
We're Certified Financial Group, where we're planning tomorrow, today. Are you tired of trying to reach your advisor through a call center and being put on hold for 20 minutes? That's why we don't use one, and our clients seem to appreciate the personal touch.
They always answer my questions and really care about what's going on with me.
You can trust what they say, and they do what they say, and it gives you a comfort feeling it's hard to find in the world today.
You know, waiting for you to call almost. You almost feel like that.
We're a certified financial group, but we're planning tomorrow, today.
As an investor, you want peace of mind. You need to know that your advisor is not only thoroughly competent, but also a fiduciary. In other words, he or she is acting at all times in your best interests. You need to trust your advisor, regardless of how much money you have to invest or what part of the world you're in. It might not be your money you're entrusting the advisor with. Perhaps you're a board member of a charity or foundation whose future depends on prudent investment. Or perhaps you have the responsibility of making investment decisions on behalf of other people. As the trustee of a retirement plan, the decisions you make can have a direct impact on the lives of your employees. Whatever type of investor you are, the solution is to use an advisor certified by the Center for Fiduciary Excellence. A CFEX certified advisory firm demonstrates its adherence to a global fiduciary standard of excellence, a defined standard with specific criteria covering 21 best practices. The documented, repeatable processes and the evidence-based decision-making that CFEX demands are more likely to generate investment portfolios that match client needs and expectations. And because the firm voluntarily agrees to a rigorous annual audit, investors can rest assured that their advisor continues to work to the highest professional standards. This independent verification is even more critical for trustees and investment committee members of retirement plans who are legally required to conduct regular due diligence on their service providers. Use a CFEX certified firm, and that job has been done already by an expert at no expense to the plan. So why leave anything to chance? Insist on working with investment professionals you can truly trust. Insist on using a CFEX certified advisor.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, hey, Lou, I need to, I'm barbecuing this weekend, right? What do you like? And Lou goes to the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal? Oh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak. Just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit. It's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy. Your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs, she's going to take all the measurements, she's going to run all of her analysis, and she's going to absolutely give me her best thinking on what's best for me. Whether she's a vegetarian or a meat lover, likes this, likes that, if she thinks I should be doing something differently, even if it's not good for her, she's going to give me an opinion that's for my interest. So what's the difference between a fiduciary and the brokers? Well, these are dietitians, these are butchers. It's that simple. Brokers are butchers selling product. Fiduciaries are dietitians looking after your health. The problem is most people think that their butcher is a dietitian. So when one of your moms or dads or friends calls the broker and says, you know, I got 200 grand, I sold a little piece of property, or I got some inheritance, what should I do with it? They're going in thinking they're talking to a dietitian, and they're really talking to Lou the butcher.
Welcome back to On the Money here on WDBO 107.3 FM and AM 580, or you can also listen live on the WDBO app wherever you are. Today we have Nancy Hecht and Joe Bert from the Certified Financial Group. And if you have any questions about your finances, go ahead and give us a call here, 844-580-9326. That's 844-580-WDBO. You'll be first in line. We'd love to answer any and all of your financial questions today. Again, absolutely free. That number, 844-580-9326. You can also call Dave Balakrishnan off the air, where he's taking more private calls if you're interested, at 407-869-9800. And now, back to Nancy and Joe.
Well, we've got some upcoming workshops. Nancy, why don't we tell the listeners about it?
Sure. Okay, so the first one that we have coming up on the schedule is Social Security Planning Basics and Claiming Strategies. This is October 8th from 6:30 to 8 p.m. in our Learning Center. It's hosted by Charles Curry. And then also in October on the 18th, Getting Long-Term Care Planning Right, Smart Approaches for People at All Stages, also hosted by Charles Curry. But this one, again, October 18th, is from 10 o'clock in the morning to 11:30 in the morning.
And these are, once again, free workshops that we do for our listeners. If you have any interest in them, we encourage you to go to our website. That's financialgroup.com. Financialgroup.com. You can click on workshop and make your reservations right there. Those two workshops are really popular because the one talks about Social Security planning strategies. And you know, when you time for to claim Social Security, the Social Security Administration can tell you what your options are, but they cannot tell you and won't tell you what's best for you and your family. And everybody's family situation is unique, so you need to know what those options are, whether you're single, whether you've been remarried, been divorced, you have survivors, all that information is important for you to know. So Charles is going to cover that. And the other one is healthcare options in retirement. And some people don't really realize what those options are when you get to be on Medicare. And many people think that, you know, well, if I have to go in the nursing home, Medicare is going to take care of it. Not the case. You need to be prepared and knowing what those options are and what you have to do to prepare yourself, because for many people that can be a financial disaster. So once again, those workshops are free. Go to our website, that's financialgroup.com. Make your reservation right there. And Greg, I see we got a call floated in there from Bob.
That's right. Bob out in Windermere's got a question about deferred compensation. So Bob, you are on with the Certified Financial Group.
Good morning, Bob. Thanks for the call. How you doing?
Hi, Bob.
I'm well. Thank you so much for asking. Question is, I've got a family member that was involved, worked for a company. She had deferred compensation, and the company was in bankruptcy, and she was notified that although they were generous enough to give her half of what she had lost, she lost half of the deferred compensation in the restructuring. The question is, the amount that she lost, although she didn't pay taxes on that income, is that income deductible of some sort because she had earned the income?
No, unfortunately. Unfortunately, that's the challenge that you have in what's called non-qualified deferred compensation. It's where, for our listeners who might not be familiar with that, this was your sister, you said?
No,
He said a relative.
A relative,
He
okay.
didn't identify who.
Okay,
Yeah.
I'm sorry. In any case.
Now it's my wife.
Okay. All right.
Okay. So what she did is she had money withheld from her paycheck and sent it into what's called a deferred comp. It's kind of like a 401k plan, but the difference is a 401k plan is regulated. It's separate money. It's got to be in a separate account, whereas non-qualified deferred comp means it's being held by the company. And unfortunately, when the company has financial troubles, that money is subject to claims of creditors, and that's what happened to your wife. And I understand your willing or desire to take a tax deduction for it, but she already got a tax deduction when the money went into the plan. So unfortunately, it's just a loss that she has to bear. So
Thank God she got at least half of it back.
Yes.
That's correct. I mean, it's it was a godsend anyway. It came at just the right time. The money that she was giving back is paying for our daughter's surgery next week. So, in any event, it was a good experience, and it was a good learning. And now I have to give my son, who is our financial advisor, credit for having the right answer.
So you're hoping I take something different.
Okay.
I hope your son told you, Bob, that money is going to be taxable to her. So you got to be prepared for the tax consequences of that if you're getting a lump sum.
Absolutely,
That-
yes, he
the-
did.
Yeah, the
He
half
did
that she
that as
got
well.
back.
Yeah,
So,
yeah.
all right.
Okay,
Well,
good. Thanks for the
Thank
call,
you so
Bob.
much.
Yeah,
God bless
sorry.
you guys. Bye-bye.
Okay, sorry for your loss, but for our listeners who may not be familiar with non-qualified deferred compensation, that's exactly what happens. So, all right, Greg, I see we had another text question float in there.
That's right. It looks like we've got a question here from Michaela out in Lakeland. Michaela wants to know that given the U.S. stock market's strong performance recently, how do I know if my current asset allocation will still make sense for my risk tolerance and long-term goals?
well, that's a great question. So part of what we do twice a year is we look at the balance between equities and income for our clients and see if they've gotten out of whack, exactly as Michaela is questioning.
So for our listeners who might not know why it goes out of whack, why does it go out of whack?
Well, as a lot of people that are taking their RMDs know, we had a really good year for equities last year. So the stock market went up a lot. So the balances on the stock-based investments went up a lot. And a lot of people are over, they have more in growth items than they do in income items. And how do we know what is appropriate for them? Well, for our clients, we have everybody take a risk tolerance quiz. And it's a number of questions. It's not a big quiz. I think it's, 10, 13 questions. Some of them are even pictures to look at and pick an answer as opposed to having to read something. But it gives us a good idea of what people are willing to tolerate as far as risk goes. Most of my clients fall into what we call a moderate risk category, which is 60% of their assets in equities and 40% in income. So what I saw at the end of last quarter was that a lot of the equities had gone up to 75 or 80%. And it was a matter of looking at, were they in qualified funds? Were they in non-qualified funds? How can I rebalance and not put somebody in an adverse tax situation? So if Michaela has never taken something like this, she might want to reach out and, see about taking the quiz and get an idea of her risk tolerance and then how things are looking on her own investment statements as far as her balance between the equities and incomes, and maybe book a complimentary consultation to look at how things are laying out for her and does she need some help and maybe realigning things.
What Nancy mentions is what we do when we actively manage our clients' portfolios. We just don't set it and forget it. We're keeping an eye on it, and really we have you do what everybody needs to do, but they're reluctant to do because, once again, of emotions. And that's to sell high and buy low. And so when things get out of whack because we've had a good equity market, you want to take some of that profit off the table and reallocate it to the things that are down at the moment and just keep that ball rolling. But you also have to consider the tax consequences in that.
Right.
You're a little more flexible if it's in a retirement account. But nevertheless, it's something that should be done. Otherwise, you find out that your 60-40 portfolio is now an 80-20 portfolio. And when the market turns, it gets ugly, and you wonder, oh, what happened? I lost all that stuff. So that's what rebalancing is all about. We hope we answered that question.
Well,
go ahead.
You just said you lost all that stuff, but you see the values will decline. You're not.
Oh, that's correct. That's
you're
correct.
not taking a loss.
If you haven't lost it, then let yourself. But it's the psychological part. In your mind, you've lost it, but
Right.
on paper, you haven't lost it. On paper, you've lost it, but you haven't lost it until you do something out of emotion, which is not the best thing going.
I always like to tell my clients, and what we've just gone through with the interest rates being high and the price per share and the bond funds being low, that maybe for the last 5 years before you're ready to retire, if everything is down and you have quality, then you're able to buy and reinvest on sale, and then a year or so before you're ready to retire, everything goes back up in value. That would be the ideal way to dollar cost average into your investment.
The ideal thing. So you mentioned that magic term, Nancy, dollar cost averaging. For our listeners that might not be familiar with it, what's it mean?
Okay, that is investing regular amounts of money over a regular period of time. And anybody who has a corporate savings retirement plan, 401k, 403b, something along those lines, you're doing that with your payroll deductions. So every paycheck that you're having money taken out and it's going into the various different funds within your accounts, you're dollar cost averaging. And hopefully when the deposit hits into your 401k or 403b, it happens to be a day when the markets are negative and you have an opportunity to buy on sale.
It's the best way to accumulate money over the years. Do it on a systematic, disciplined basis, regardless of what's going on in the world. You're going to catch a lot of lows, you're going to catch some highs, but it's really a way to accumulate money on a regular basis as opposed to waiting to get a big chunk of money and then make that investment.
And if you go back to the revenge savings that I was talking about, you know, if you set something like that up for yourself, whether it's in a taxable account or a tax deferred account, once you've gotten probably 6 months past, you know, doing your regular savings, it really doesn't have that much of an impact on people's lives anymore.
Right,
It's
right.
just, you know, part of the regular expenses, but it's an expense that's beneficial to you.
And you learn to live without it. And
Right.
that's really the, you know, you need to pay yourself first, because if you don't pay yourself first, there's nobody else that's going to put money in that bank for you. So you got to set out that discipline, right? Time and time again, we stress, particularly with our clients, is tell your kids, if they're just starting in the workforce, use their retirement plan. And if they're in a low enough tax bracket, put in the Roth portion of the retirement plan. But do something and get started on a savings plan, because savings is a discipline. It's like working out and dieting. You know, it's tough to do, but it's something that everybody needs to get started on.
So a couple of the terms that you just threw out are, I mean, I started in business in '83. I know you started a little bit before me, but pay yourself first. And, you know, dollar cost averaging, there used to be a way to invest with the mutual fund company I worked for. They had this contractual plan where you would commit to saving a certain amount of money every single month. And, you know, these are really, really old ways in terms of looking at things for money, but they have not gone out of style. You know, and with as automated as everything is today, it's so much easier to set something like that up for yourself.
Yeah. So even if you don't have a retirement plan at work, you can set up an IRA to do that.
Right.
And have it automatically debited from your checking account. And, you know, like any bill, it comes out right off the top. And if it's not there, you're not going to spend it. So we encourage our listeners, if you haven't done that, by far and away, it's really the key to providing long-term financial security for yourself and your family in those golden years. And I see we're up against a break there, Greg, so take it away.
That's right. And we do still have those open phone lines. If you've got a question, we've got a few minutes left coming up after this break. Give us a call here, 844-580-9326. That's 844-580-WDBO to answer your financial questions. You've been listening to On the Money, where we're planning tomorrow
Today
with the Certified Financial Group.
So you guys don't know Chicago, but I'm sure in your neighborhood you guys have an old school butcher where you walk in and there's a bunch of guys, no gloves, big white aprons, and there's Frank and there's Stevie and there's Mikey. And these guys know more about meat and more about animals and more about cooking the meat than any of us will ever learn. And so you walk in and you say, hey, Lou, I need to, I'm barbecuing this weekend, right? What do you like? And Lou goes to, the big racks of stuff he has underneath the glass, and he goes, the veal chops, just in from Argentina, they are the bomb. And you go, veal? Oh, I like veal. Well, what do you got on skirt steak? Oh, we got some great skirt steak. Just came in yesterday from Montana. Skirt steak is one of my favorite, marinated up a little bit. It's fantastic. Lou will never say to you, Elliot, it's a little long on the meat here, big guy. Your cholesterol is getting high. Why don't you go down to the fishmonger a couple blocks and have a nice piece of salmon? Right? He'll never do that. Why? His job is to sell me meat, and I go in, actually the same way I go into the Toyota dealership, because I like Toyotas, and I trust the salesman to sell me a good product if I trust him. And the fact that he's got my interest at heart vis-a-vis my expectations for selling me that thing. By the same token, when I go to see a dietitian, I know she's going to look at all of my labs, she's going to take all the measurements, she's going to run all of her analysis, and she's going to absolutely give me her best thinking on what's best for me. Whether she's a vegetarian or a meat lover, likes this, likes that, if she thinks I should be doing something differently, even if it's not good for her, she's going to give me an opinion that's for my interest. So what's the difference between a fiduciary and the brokers? Well, these are dietitians, these are butchers. It's that simple. Brokers are butchers selling product. Fiduciaries are dietitians looking after your health. The problem is most people think that their butcher is a dietitian. So when one of your moms or dads or friends calls the broker and says, I got 200 grand, I sold a little piece of property, or I got some inheritance, what should I do with it? They're going in thinking they're talking to a dietitian, and they're really talking to Lou the butcher.
What is a fiduciary? When it comes to investing, a fiduciary is legally required to act in your best interest. For 40 years, planners at Certified Financial Group have been guiding our local clients toward financial peace of mind. The rest of the world is still catching up, but our team of certified financial planners are the local, experienced fiduciaries you can trust. Certified Financial Group are your Central Florida planners. Call us today.
40 years ago, I had a dream of building the best personal financial consulting firm in Central Florida. Now, with 14 certified financial planners acting as fiduciaries, I believe we're there. But don't take my word for it.
As we approach retirement, we have the freedom of choice.
Peace of mind that we now have. That's everything to us.
The people that work here are honest and caring, and I feel like I can go to sleep at night.
So schedule your no-obligation visit today at financialgroup.com, or we're planning tomorrow. For more than 40 years, our certified financial planner professionals, acting as fiduciaries, have been providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today. Our fiduciary approach of providing retirement planning and investment management for a fee seems to resonate with our clients. But don't take my word for it.
I knew a gentleman that I worked with who had come to Certified Financial Group.
A friend of mine recommended them, and they were totally correct how good they are.
I had heard from somebody else that it was the best one in town.
I've sent several of my teacher friends here.
We're Certified Financial Group, where we're planning tomorrow, today. You may be new to the area, but we're not. For more than 40 years, our certified financial planner professionals, acting as fiduciaries, have been providing retirement planning and asset management for a fee to countless families across Central Florida.
We've been with Certified since 1992.
We're now into the third or fourth generation of clients that have come to CFG and the team here to do a great job.
It's been so long since I've been doing this that I just don't even worry about anything anymore.
We're Certified Financial Group, where we're planning tomorrow, today.
Back to On the Money here on WDBO 107.3 FM and AM 580. You can also listen live anywhere on the WDBO app. Today we have Nancy Hecht and Joe Bert from the Certified Financial Group. And if you have any questions, we've only got a few minutes left, but you be first in line. Go ahead and give us a call here, 844-580-9326. It's 844-580-WDBO. You can also go ahead and give a call to Dave Balakrishnan off the air. He's taking phone calls at 407-869-9800. And Nancy and Joe, it looks like I just got an email question in. If we wanted to try and tackle that here,
Well, let's do it.
Up the show.
Yep.
Let's see. So we've got good morning. I'm 74 years old, and 40% of my portfolio is currently invested is Thomas Partners Balanced Income through Schwab, which is 60% equities, 40% fixed income. Equity sided, 50 plus individual dividend paying stock. The fixed income side, bonds, ETFs, is maybe too risky for considering their age. That's their main concern here, is that 60-40 split right now. They're also working with a balanced income conservative portfolio, 40% equity, 60% fixed income, 55% in bond ETFs, and 5% cash, which is better suited for them. And this is coming from Laszlo. And they very much enjoyed the show. They also mentioned that in there as well.
I appreciate that, Laszlo. Right now, you're in what we call a moderate portfolio, right, Nancy? 60% equities, 40% fixed income. And it's been proposed that he flips it, goes to 40% fixed income, 40% equities, and 60% fixed income.
And he says 74, so I'm like, okay, so you were probably have a good 15 years ahead of you. And I don't have a problem with the 60% equity portfolio for someone who's 74. I mean, if you're feeling a little bit anxious about it, maybe taking it down to 50-50, but the equities are what keep you ahead of inflation. And, you know, looking at longevity, I mean, most people are living now till their late 80s, from what I'm seeing. You know, so that's a lot of time for that money to have to work for you. The one caveat is, though, that you have to be able to sleep at night. So you have to do what's comfortable for you, and really not knowing what other types of areas he has money saved or invest. I mean, what are the cash reserves like? Is that enough to, you know, take up part of the income portion? There's questions that I would want to ask before I could give a solid answer. Yes, you should flip it, or no, you should stay where you're at right now.
The beauty of the financial planning software that we use, Laszlo, is the ability to crank in a lower rate of return and show the actual impact to you on your living expenses and your lifestyle going forward. And if we find out that dropping from maybe a 7% return down to a 5% return will still get you there with a high degree of security, go for it. But if you find out that, you know, it looks great now and I'll be able to sleep at night, but in 7 years I'm going to be really eating into my principal, that may not be such a good idea. And this is where financial planning comes in. It's not a matter of just picking some investment portfolio off the shelf and hope it works for you. This is where retirement planning, it comes into play, where we look at your income, look at taxes, look at your inflation, look at what big expenses you might have coming up. All those things need to be factored in, and then you determine what's that rate of return I need to be able to accomplish those things. So maybe, you know, maybe this works for you, maybe it doesn't. You asked a good question, but without really knowing you and doing a thorough exam, it's difficult to give you a recommendation. But what you're doing, as you're well aware, is you're going to a more conservative portfolio.
And you might want to take our quiz. So you shoot me an email and I can shoot you the link for the quiz, and you can see how you feel about risk.
There you go. Nancy at financialgroup.com. And I see we're winding up the show. Go to our website. That's financialgroup.com, financialgroup.com. Get all the info on our upcoming workshops.
And thank you all so much for listening this afternoon. You've been listening to On the Money here on WDBO. We're planning your tomorrow with the Certified Financial Group.